Canaccord Genuity Wealth Management. We have Rob Tetrault.
Rob Tetrault.
Rob Tetrault.
Rob Tetrault.
One more time with Rob Tetrault.
Well, I preach quality. I've preached quality since day one to all my clients. The bubble's going to burst. You know, the bubble will burst. Mark my word, folks. I'll strongly advise them. It's got to be speculative. It's got to be less than 5% of your portfolio at the absolute most. And it's got to be money you know you could lose. Anytime I see a deal, Paul, I always look at the metrics. Did they issue debt or did they raise capital? You know, you got to be buying right now. When the market corrects, you got to be buying. If the market does correct, we'll be ready to deploy. The gentleman at the Seaport Motor Hotel in Churchill, Manitoba can only drink so many beers. I think it'll happen. I think there's going to be retail, recreational marijuana tax rules change as we see with the Trudeau government. Tax rules are ever changing. So the job numbers in the U.S. like they've been unbelievable. We would have said that that's impossible. And now we're staring in the face, even with a trade deficit. These are very strong GDP numbers. And if you are adding, it's the ball that keeps rolling. If there's an opportunity on a correction, we always like to buy on dips. And once they start buying, that market starts moving, and you don't want to miss the party, the FOMO factor. But again, we don't get too excited, we don't get too down, but it was a good month. I always say, don't get too excited when things are going great, and don't get too down when things aren't going great.
Hey! Feel obligated to clap. I like that. Welcome, everyone. Bienvenue tout le monde. Thanks for coming. I'm usually not too excited about anything, as you saw over there, but I am jacked about tonight. Really, really excited. Not every day we get to have the panel that we have here today in front of you guys. Really excited to introduce them. First of all, I'm just going to tell you a bit about the Leadership Series. This is the sixth annual event in the Leadership Series. We've had some really, really neat guests in the past. We had Kevin O'Leary before he was in the boat trouble, and we had Brett Wilson, Jen Jones. Last year we had 3 CEOs of Manitoba companies. This year, with a focus on real estate, we have the leaders, these CEOs of 3 different aspects of real estate, and we'll talk about that in a bit. I'm Rob Tetrault, if you didn't know from the video. I'm a Senior Vice President, Canaccord Genuity Wealth Management, Portfolio Manager as well. A lot of you guys are my clients. Some of you guys aren't. I'm really, really passionate about investments. That's why we do this kind of stuff. I'm also super passionate about educating clients and education generally. I also teach at the St. Boniface University and have some of my students here today. Bienvenue. No clap for them. Yeah, you guys got to clap. Without further ado, I will take a second here to introduce our first CEO. So this gentleman here is the CEO. I gotta get your names right. The issue that I have today, folks, I'm just going to come out and say it because it's going to be a problem for me. I have a Cameron and I have a Cam, and they're kind of both Camerons. So I'm going to do my best to get their names straight. I should be able to do this. I've been working and knowing these guys for a long time. But let's start with the CEO of Timbercreek Financial. So Timbercreek Financial is a publicly traded mortgage investment corp. They focus on private debt. This gentleman has been working there in that capacity for a while. He's got a passion for finance as well. He's been doing it for a while. He looks young, but he's got a ton of experience in this space. Let's give it up, folks. The CEO of Timbercreek Financial, Cam Goodnough. Come on up. And we're going to see one of the clips from BNN, from Cam.
We have a chart up right now for our viewers to understand Timbercreek Financial versus the traditional, conventional mortgage in Canada. So there are differences in terms of the size of loan, 1 to 50 million for you, 50 million above for perhaps the traditional institutional lenders. Yeah. What else differentiates you? And it's almost as though it's a mid-market approach, if that's fair to say?
Yeah, it is fair. I mean, we, at the end of the day, build our business around flexibility, customization, and service. Those are the 3 hallmarks of our business, and it's how we'll continue to build our business. We are a transitional lender, so our forte is helping purchasers of properties acquire a building that needs a little love, that needs a little work, whether that's re-tenanting, repurposing, redeveloping. Something needs to be done to that property to get it to a stabilized place. The traditional lenders, be they banks, pension funds, etc., they like stabilized assets and lend at rates, 150 basis points lower than we're lending. And so, there's a very specific market for us. We think it's a large and growing, and we can excel, particularly in the multi-res space in Canada.
Cam Goodnough, folks. He's going to talk to us about private debt, a space that some of you know, but I'm sure a lot of you don't. The next CEO is a Manitoba success story, a proud Manitoban. I got to know Armin, I believe I was like my student's age in university, back when my dad was doing deals to make this company first go public through a capital pool company, doing like a $200,000 raise, and then bootstrapping together $4 or $5 million or something to try to buy the first building that they bought. That would have been, I believe, 15-ish years ago. So really, really excited to have him here today. He's the CEO of the publicly traded REIT, Artis REIT, which is a multi-billion-dollar company. Really excited to have him, folks. Give it up for Armin Martens.
Artis REIT is a Winnipeg-based diversified real estate investment trust and is one of Canada's most prominent landlords. Since its inception in 2004, Artis has grown from a single retail property to a portfolio of 229 commercial properties, representing 25 million square feet of leasable area and over $5.5 billion of assets. Artis Real Estate Investment Trust is publicly traded on the Toronto Stock Exchange. The REIT's primary objective is to provide a tax-efficient monthly cash distribution and long-term appreciation in value through the accumulation and effective management of a quality portfolio of commercial real estate. Artis's portfolio of office, retail, and industrial assets is located across 5 Canadian provinces and 5 U.S. states. To manage this extensive portfolio, Artis has 7 offices located in Winnipeg, Calgary, Edmonton, Toronto, Minneapolis, Madison, and Phoenix, employing 225 people, including a highly experienced management team and fully internalized asset and property management platforms. Artis's acquisition strategy is focused on environmental sustainability, future growth potential, and assets that have a competitive advantage in their market and asset class. This ensures the REIT is strategically positioned to provide long-term and sustainable growth for our unit holders. The portfolio is approximately 95% leased to a diverse list of quality tenants with a weighted average lease term of over 5 years. Over the last decade, Artis has established a solid track record of greenfield developments in both Canada and the U.S. These new developments provide an opportunity to achieve growth at attractive yields while improving the overall quality, energy efficiency, and revenue growth potential of the portfolio. To date, in 2019, Artis has completed construction of 3 state-of-the-art industrial projects in Houston, Texas, totaling over 1 million square feet of leasable area, 2 of which were fully leased before completion. Artis expects to complete another 350,000 square feet of new development projects during the remainder of the year, including an industrial project in Denver, Colorado, and a retail project in Winnipeg, Manitoba. This retail project is adjacent to one of Artis's significant ongoing development projects, 300 Main, a 40-story amenity-rich apartment tower near the corner of Portage and Main, above the shops of Winnipeg Square and Winnipeg Square Parkade. As the company continues to optimize its portfolio and deliver brand new, best-in-class real estate development projects, Artis is also focused on making improvements to the balance sheet. Artis's units provide a yield of over 4%, which represents a conservative payout ratio of approximately 55%. With a defensive balance sheet and portfolio of assets, Artis's strong and dedicated board and management teams are committed to meeting its primary objective, maximizing total returns to unit holders.
Good stuff. That building's going to be unreal, I think, when it's done. You guys probably drove by it on your way here, some of you for sure. Looks really neat. All right, let's move on here. The third space of the night is the private real estate equity space. So this term can be loosely referred to as private equity. For tonight, I'm going to refer to it as private equity. We're lucky enough to have a CEO who flew in. Actually, 2/3 of our crew here flew in from Toronto. Armin flew in from private jet, I would imagine, from East St. Paul. That was a joke, Armin. I know you don't have a private jet. We are excited to have Cameron here. Cameron is the CEO of Equium Capital. So Equium has a focus, traditionally has been a focus on private real estate. They look for superior gains, superior tax-efficient gains in projects. So finding something through either a low-hanging fruit, through a competitive advantage that they have, where they're able to convert is the word I'm looking for. They're able to convert the asset into a revenue-generating property and then exit the property at a significant profit. Really excited to have. He's going to tell you all about it. Ladies and gentlemen, put it up. Cam Hurst.
Is it a given that if the economy slows down substantially, stocks drop?
You do tend to think of things in terms of the tide. So you've got the rising tide lifts all boats, and so it goes also on the lower tide. We would say, though, if you get a moderate pullback in the economy, so a moderate slowdown in the economy, zero-ish growth, maybe it goes negative and you have a technical recession, but so long as it's not a deep contraction, you do get a decoupling and differentiation, we would say a higher dispersion in equities. So you can stock pick better. So for example, you want to go into REITs and specifically multifamily because they do really, really well in that kind of environment. Energy and the hypercyclicals, you want to be really careful of those. So in that sort of moderate environment, we can still find pockets of equity exposure. So let's say we're still in the 30-35% range. We can find good structural stories there. But for the first time in years, we're more bonds than we are equities.
Okay. We're going to be back with Cameron Hurst, Chief Investment Officer at Equium Capital Management, answering your questions on U.S. stocks. Give him a call, 1-855-326-6266.
We will be right back with Cameron Hurst. Let's get into the three different types, and I'm going to do my best to explain it to you guys before these guys do, because in theory I should be able to explain this, right? It's kind of my job. So to your far right, we have the private debt space. Private debt space, my far right, your far left, sorry. Cameron with the, Cam with the Coquelicot, the wonderful Coquelicot in honor of the Remembrance Day that's coming up. I think it's a day early. Usually we do it after Halloween, but that's okay. We'll forgive you. Really excited to have him here because his focus has always been on private debt. So private debt we're talking about, and he spoke about in his videos, so non-traditional lenders. So the banks, for whatever reason, these either pieces of property or real estate need a bit of loving. They either need to be converted, and banks are not looking at it for whatever reason at that moment. So they would come in, they, maybe at 150 or 200 or 250 basis points higher, something like that, and they would provide typically short-term financing to these projects that are secured by the underlying asset, which in pretty much all cases is the real estate. And then as a result of that, they own the first mortgage on the property, they collect the short-term payment. Once the rentals are done or the project's expanded or whatever it may be, the bank usually takes them out. I'll let him explain it further, but that's how they're able to generate a nice consistent yield in their MIC with relatively low volatility. So the current yield, I believe, is what was that? 7.2%. It's a conservative play for anyone who's. I'll let him tell you about this, but I think it's a conservative play for anyone who's looking to get some income, less concerned about tax efficiency, wants stability. I'm going to let him come up here and give you guys a brief presentation on what he does. I'll give you the microphone. What's that? You're coming up. Oh yeah, you're up right now. Cam.
Sorry, it's a new presentation for me, so I actually have a few cheat notes to make sure I don't miss anything. First of all, thanks for everybody coming tonight. I also need glasses these days to see what I'm saying. But first of all, I got to figure out how to turn this on. There we go. Okay. Thanks for everybody coming tonight. Very much appreciate being a part of this great event. Thank you, Rob, for including me, and seated next to some other great, outstanding CEOs in the real estate space, and enjoying some great Winnipeg hospitality. Have to admit, I was a little cold coming off the plane and seeing some snow on the ground. Wasn't quite prepared for that in my spring jacket. So here's the obligatory. We're a public company. Which way am I supposed to point this?
It's the other way, I think. I think it's this way. Yeah, so hold it like that and down.
Down? Thank you.
Hold it the other way.
The obligatory disclaimer that compliance requires us to include in any presentations that we give. GFC, Global Financial Crisis, in case anybody's wondering what that acronym is. Wow, it's already been 11 years. Still affecting us every day, isn't it? You've got, as far as its impact on private debt, really before 2008, private debt was a niche asset class, the purview of some of the world's largest investors. And it was pretty much non-existent for everyday people. But what changed coming out of that financial crisis was really a change in regulations. I'm going to throw some terms around here. Bear with me a little bit. Basel III comes out. They make the banks basically shrink their loan books and build up the capital inside the bank. This has affected things like you saw some in Canada. You saw the mortgage rules change, started pushing people outside the banks in order to get their mortgages. And then secondarily, in the your bottom right there, QE, quantitative easing. So these programs basically overinflated the value of traditional assets, be they equities, be they bonds, and they drove investors to seek alternative sources of income return beyond what the traditional asset classes. Sorry. What's everybody's GIC portfolio yielding these days? Not a lot, right? It's pretty hard to make a buck. Quantitative easing basically flooded the world with a lot of cheap money, and the net result of that was exactly that, a lot of cheap money. There is over $17 trillion US right now at negative rates. That's, what's that say up there? 20-something% of the total debt outstanding globally is negative yielding. A decade after the Great Recession, we have inverted yield curves in a large part of a large number of countries. Most countries right now are in some form or fashion have some component of the yield curve inverted. And for some of those countries, there's a real risk that they could get stuck in a Japan-like holding pattern for an indefinite period of time. Here at home and elsewhere, you've heard the economists calling for at least 5 years now for rising rates, right? How many of you think we're going to have a material increase in rates in the next 12 months? Probably not many of you. Now put yourselves in the shoes of somebody who runs a defined benefit plan and with a liability gap. And what I mean by that is that their assets don't cover, well, I'm sounding closer to the mic than I was before. Their assets don't cover their liabilities. In the US alone, there's $3.8 trillion. That's the size of the liability gap just for defined benefit plans in the US. So if you're concerned about high values in the equity markets and you can't generate enough returns out of the traditional fixed income categories, where do you go? Many of those investors have turned to alternative asset classes, which are now available, unlike they were prior to 2008, generally more available than they were, and investors big and small can participate in alternative asset classes. I'm here to talk about private debt. Private debt alone is up 3 times in the last decade in terms of the amount of money deployed globally into private debt. That it does not include $400 billion US of dry powder. What do I mean by dry powder? Basically, there are investment managers such as myself who have gone out and raised the capital from investors and are waiting to spend it on deals. So expect that number to go up. And yet, as a whole, even at these numbers, still only representing 5% of the really big balance sheets. The global pension funds, they're still only about 5% invested in this asset class. So as investors are looking for uncorrelated, steady return opportunities, why not private debt? It's outperformed traditional fixed income for the last 20 years or so. It's seen as a crossover asset class. It's got equity-like returns, and yet debt-like volatility and downside protection. So try to follow me from left to right at the bottom here. After the financial crisis, investors got a little shell-shocked, started moving out of equity, started moving into fixed income. That cash, what it did is it started to increase the price. People started bidding up the price for traditional fixed income. And you've all heard this before, in terms of fixed income world, as the prices are going up, the yields are going down. In other words, people were willing to accept lower and lower rates. They used to get 5% on their GICs, but you know what, 4.5 doesn't sound so bad, so they'll pay a little bit more. You know what, 4 doesn't sound so bad. So as they were flooding the cash in, they were actually compressing the yields on that fixed income. But their target returns didn't change. Your target returns didn't change. You still needed to make that 5. So how am I going to make that 5 if that's my target return? Well, what they did is they started moving into private debt. It offers a similar risk profile, as I said, similar volatility levels. You've got downside protections. It's a logical place to go. As capital is continuing to flow into private debt, I think it's incumbent upon everybody to ask themselves, at what point do you have to start moving out the risk curve in order to maintain that target investment yield? So at some point, as money continues to flow, that's also you're going to see compression of yields in the private debt space, and we're already seeing that today and have been seeing that for the last couple of years. Or is there a new asset class that investors start focusing on? I'm going to switch the order here. Pardon me. Not all debt is created equal. Listed here on the right-hand side of the slide are some of the considerations that investors should look at and think about when they're making an investment in not just private debt, in all debt. Two opportunities may invest in the same type of asset, but it doesn't mean they have the same risk. My mom used to say, and I think all of our moms probably used to say, that if it's too good to be true, it probably is. And investors need to get behind the macro level stats and the marketing buff and figure out what's in the underlying portfolio that this company or this fund is investing in, because that's really what I'm investing in, indirectly through the fund or the company, but I'm really investing in this portfolio of assets, and what does that constitute? There is no free lunch. Even a totally unsatisfactory sandwich like the one on this page, it's still not free. You can't generate 7, 8, 9% returns without taking some kind of risk. It's just not happening. So think about that as when you're thinking about your options available to you and what your target returns are. Some private debt managers will, in the real estate space at least, will go out the risk curve to generate those kinds of yields by taking what I call asset level risk. So there'll be raw land, there'll be construction. So there's downside with those. If there's a break in the economy or something happens, it's a riskier asset class, and you get paid for that. Other managers focus on income producing assets and then use leverage as their choice of risk in order to generate those kinds of returns. In our case, Timbercreek Financial, we have a pretty defensive posturing, and we use the latter. Well, we prefer, and you'll see some stats at the end of this presentation, to focus on income-producing properties. If and when the time comes that the music stops or at least slows down, at least the properties we're lending to generate enough income to keep the mortgage current. And that's what's important to us as debt investors. I mean, after all, we lend $1, And if we do our job right, we get 100 cents back. And there isn't the upside potential, so you better make sure you manage the downside. I got to go the opposite way now. Yes. When most of us think of real estate, we think of in equity terms, right? We buy a house, maybe a cottage, and we probably borrow some money to do it. The mortgage industry is massive, 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 and is dominated by the country's largest financial institutions, the banks, the credit unions, the insurance companies, the pension funds. But given those macro drivers we talked about earlier on, around Basel III and quantitative easing and all of that, they're no longer the only players in the space. There's been a real surge. There's been different terms for it, alternative lenders, shadow banks. Private lenders is probably the nice way to say all of that. And we at Timbercreek Financial, we're focused specifically and exclusively on commercial mortgages. We don't do single-family homes. We don't lend, to single-family homes. And that category is in the top left, where we're lumped in with a bunch of other commercial lenders. It's about a $40 billion of the $300 billion market is private lenders in the Canadian commercial mortgage space. So the $300 billion market can be divided and dissected in any number of ways. This is how CMLS aggregates the group into these 5 categories. I've highlighted the conventional plus segment as the area that we focus on. Least risky to most risky in that category. And you'll note that in our category, we compete mostly with the other financial institutions, the banks, the credit unions, and life cos that I've mentioned before. They have about 3/4 of the business that occurs in the conventional plus space. And you can see the kinds of yields that we can charge on the underlying borrower. So these are people who are generally looking for short-term financing to complete some component of their real estate strategy. These are professional real estate entities. 5 to 7s is the kind of range that we'll lend, is general, not just ours, but for the space itself, conventional plus. Other investment managers will focus more on the high yield space, some eye-popping yields there, right? But as mentioned, there's no free lunch. You got to make sure you understand what the risks are associated with it, getting those kinds of returns. All right. So now a little advertisement on Timbercreek Financial. We trade on the TSX. Our market cap's around $800 million. Our portfolio today is about $1.2 billion of commercial mortgages. We've been lending for about 12 years, started just before the financial crisis in 2007. Put out in total about $5 billion of mortgages over that 12 years, and haven't lost a dollar of principal over that period of time. In fact, the financial crisis was really a boon for us as not just investors sought out places to park their money, but borrowers looked for places that they could actually get access to capital. Just because we haven't lost a dollar principal doesn't mean that everything always goes to plan. In fact, whether you're a private lender or a big 5 bank, problems occur. And what matters when they happen is that you put the right protections in place at the start so that you can manage through if and when it happens. And this is really where I think specialists should outshine the generalists. When everything's going in your favor, it's not that hard. It's when things start to get a little rocky that you need to have the experience and the breadth and the full gambit of expertise at your disposal. Timbercreek Asset Management is a private company that manages Timbercreek Financial. We are a $10.5 billion real estate company. We have 670 employees. We use all facets across the business. We participate in public, we participate in private, we participate in equity, we participate in debt. We use all facets of that capability to make sure that we've got the right protections in place for Timbercreek Financial. So we're guided by 2 main principles. First and foremost, protection of principal. Secondarily, the generation of an attractive risk-adjusted is key phrase there, risk-adjusted return for our investors. There's challenges, of course. Asset valuations are rising, as is competition, investor demand. That's meaning there's more capital chasing deals and leading to some yield pressures we talked about earlier in the presentation, just generally speaking. Faced with this reality, our challenge is to avoid being that dog in that cartoon earlier on, chasing yield by moving too far out the risk curve. After all, we're not in the first 3 or 4 innings of the real estate cycle. I'm not saying we're in the 9th, but it's probably not the time to get too far over your skis. In conclusion, private debt is no longer the hidden gem of the world's largest global investors. But with all investments, it's important to understand not just the potential upside, but how the market's changing and what the potential risks may be. There's a quote from Mike Tyson that I love. He hasn't said a lot, but this quote does stick with me. Everyone has a plan until they get punched in the mouth. And preparing for that punch is a significant component of what we do at Timbercreek Financial every day. Thanks for your time.
I thought he was going to go with the other Mike Tyson quote. I'm going to fade into Bolivian. That's a real quote. Okay, good stuff. A lot of key points out of that. The ones that stick with me. The point about no free lunch and knowing what you own, to me, this is stuff that if you're my client, you've heard me preach this consistently. Risk-adjusted returns is another huge concept. We're going to dive into it further. I'm going to ask our next speaker to come up and chat a bit about his publicly traded REIT. But before we do so, a publicly traded real estate investment trust, a REIT, R-E-I-T. You've heard that expression probably. You probably saw it in an ad or something, or maybe you got invited here. And the title of the conference is I believe it's an exclusive real estate event, but it is a focus on REITs, real estate investment trusts. And this one is a Manitoba one. These real estate trusts are incredibly tax efficient. So these would be fantastic investments for you guys to own in your non-registered account, in your corporate account. Those of you that have corporations, that have investment accounts that are set up for your corporations, maybe you're worried about that small business grind, that $50K of income that was announced a couple years ago, the new tax rules. The income that's being paid from a publicly traded REIT and a privately traded REIT, actually, do not qualify as taxable income for that year. It's typically classified, the majority of it or all of it, as return of capital, ROC, as we call it in our industry. Extremely tax efficient, does not touch your limit for the $50K, which would grind away at your small business tax exemption. So instead of being bumped up to the 30% range, if you're right around that $500K mark, you still get the 10% tax range in your corporation. This is huge. This is not talked about. I definitely feel like I'm living in a world of make-believe because I'm the only one talking about this, but really significant. On top of that, this REIT is yielding about 4+% right now. The AFFO, the funds from operation, the adjusted funds from operation, which is what AFFO stands for, which is the real number. It's effectively your cash flow, but I'll let Armin get into that. I imagine he's going to get into it. If not here, for sure in the fireside chat, which is coming up right after. Those funds from operation that are being generated from these senior buildings and this quality portfolio of real estate that Artis owns, has hovered anywhere from kind of 8 to 10 or even more. So that means at the end of the day, maybe you're only getting 4 or 5 or whatever the yield is on the stock, 6 or 7 or sometimes 8. But the funds from operation that the actual real estate portfolio is generating is significantly higher. And Armin's going to talk about that. A wonderful Manitoba success story. Armin Martens. Oh, wait. I need to announce this. If you guys need to go to the washrooms, they are only accessible through this door, I'm told. All right? So only accessible through this door. You go out, you come back in.
Thank you very much, Rob, and everyone for joining us tonight. Can everybody hear me okay? All right, I'm just going to figure out this. Forgot my notes. I've just got a flip book here that matches that slide presentation because I'm not a giraffe yet. But I'll see how this works. Anyways, yeah, just as a follow-up then to that video on Artis REIT, you'll see this. I'll go through a couple of slides and make a couple more points and give you more information. This is my favorite slide because it's a picture of one of our favorite buildings. It's in Scottsdale, Arizona. It's a head office. Our U.S. head office is located there. I love that one. And this is working good. So this obligatory map shows you what we own and where we own it. Again, we're a $5.5 billion REIT, diversified in 3 asset classes, so office, industrial, and some retail. We're in Canada and the U.S. We're in 8 major markets, basically in those 2 countries, about 230 properties, 25 million square feet, and a good occupancy level. We're fully internalized, by the way. We have about 220 employees, and we do it all. We do our own asset management, property management, leasing, even our own blue shirt building maintenance. Now these pie charts, sorry, I went the other way. And it wasn't working. Okay. There we go. Sorry about that. So these pie charts show you then how we make our money and where, by NOI, by income. On the left, you see where we are today, about 50-50, Canada and the U.S., and at the bottom, you see it's about 20% retail, 50% office, 30% industrial. Follow the arrows to the right, you'll see where we're heading in the next couple of years as we reposition our portfolio and improve our growth profile. We'll be about 40% in Canada and 60% in the U.S. It's just basically about the opportunities and the value proposition we're seeing there. And then we'll be shrinking our office to 45%, shrinking retail to 20%, and increasing industrial to 40%. And it will definitely make us a better REIT. So now we'll move into some other general information, macroeconomic, if you will. So the world we live in, this pie chart shows you the debt, household debt to disposable income in the G7 countries. So Canada's on the far right, the red bar. Canada's now number 1 in terms of household debt as a percentage of disposable income in the G7 group. We used to be at the bottom on the left side. In 8 short years, we've climbed all the way to the top, and it's more making the news more and more here in Canada. And if I showed you the same bar graph with total debt in Canada, household debt, corporate debt, government debt, we'd still be number 1. We're just doing great in that area. Now this chart is a little busier, but it shows you the baby blue, if you will. Excuse me. That's what I call the sea of debt. The blue is the sea of debt, and as you can see it climbing there. As you go further to the right, it continues to climb. And again, you can add corporate debt, add government debt, and it still keeps climbing to a very high level. The only thing to think about is if we have 3 legs to our economy, government, corporate, and household and consumer, well, the consumer debt is very high, government debt's very high, corporate debt's still not bad. I think corporate balance sheets in Canada are still pretty good, but lately they have been going for the temptation and increasing their levels of debt. The red wiggly line there you see there is the 10-year bond curve. You see it's gone down, and the black line is the overnight rate, and we now have, as Cam was saying, we've got yield curve inversion. That doesn't necessarily mean there's a recession coming. Every yield curve inversion, or every inverted yield curve does not mean we're getting a recession. But on the other hand, we've never had a recession that wasn't preceded by an inverted yield curve. So something to think about. The other thing is the bottom line that this isn't right. Short-term rates shouldn't be higher than long-term rates. It isn't right. And I wish Governor Polos would have lowered rates today. I don't see long-term rates going up to correct the yield curve. I think it's up to the Bank of Canada to correct the yield curve. My favorite professor here, Economics 101, we're living this real time, right? We're experiencing this. As the longer interest rates stay low, the higher the level of debt will increase. It's just human nature. It's just the way life is in all countries. So low interest rates for a long period of time means debt levels rise. Point number 2 I make is, if you're living in a country or an environment where debt levels are high and taxation is high, that invariably puts negative pressure on GDP. And that's Canada, that's a lot of the G7 countries right now. It's putting a damper on the GDP. And so what do? You've got this devil's circle going. Debt keeps climbing. How do you solve that? Well, our government's taking up a lot of space in our economy. Will they do the right thing and tighten? Will they shrink the size of government? Or will they give us better public policy that'll accelerate economic growth in the private sector? I don't see either one coming. We're waiting for better public policy of some sort that'll help the private sector increase productivity. And I don't see government shrinking. So then we're chasing our tail, and we're back to the subject of central bankers. So what's a central banker to do? And this slide didn't show up, huh? Here we go. We'll have to keep pushing this. But I'll go up one more. I'll try this again. All right. What's a central banker to do? First of all, fighting inflation is difficult. We're not in the typical inflationary cycle anymore where the economy's moving red hot, inflation's rising, central banks can just raise interest rates until the economy slows down, then they can lower them again. We're not in that cycle anymore. Now they're fighting deflation, and our governments are concerned because they need to pay off today's debt with cheaper dollars in the future. They can't pay them off with real dollars in the future. And the central bankers know that, and they'll get to it. So what do? They lower interest rates some more. I mean, that's an option. That's maybe the only lever they have. They say they have a lot of ideas, but that's the main lever they have, lowering rates even more and for longer. I've got this. And the negative interest rates, we can't mention that, and we'll talk about it some more. It's definitely a reality for Canada and the United States, as well as for the UK now as well. More quantitative easing, we'll see. Buy equities. A little fun fact, the Bank of Japan, Central Bank of Japan, has been buying common equities on the Tokyo Stock Exchange for years now to help improve the liquidity of these companies, improve their cost of capital, and help the economy. So those are the kind of things that central bankers have to think about now, and they've got to be worried about that inverted yield curve because they have to fix it. So then what does an investor do? And here we are. You get your chance to talk some more. So it's just going in the wrong order. I apologize about this. I'll just put them all up there first, and then I'll talk about them. There we go. So, buy bonds, well, I'd say not for the yield. Buy lottery tickets, maybe. Buy equities, yes. Buy real estate, yes. Buy REIT securities, yes. Now, to go back to the top, I mean, gone are the days when we can buy Canada savings bonds or GICs and just click the coupons and relax. There's no way around equities of some sort, some type of equities, if you want to have a good financial plan, no matter how old you are. Lottery tickets, if you're good at them, you should buy them. Gold is also a maybe. I didn't put it in there. Equities, common equities, of course. Real estate, of course. I mean, I own all kinds of real estate. I own real estate directly. I own LPs, units, and I've got REIT securities, of course. My largest investment is my REIT. Back to bonds, there's still such a thing as bond funds, and there's such a thing as mortgage funds, and that's where Timbercreek comes in, that give you a good yield, and there's capital appreciation potential there as yields come down. And I think we're in a low interest rate environment where interest rates will be coming down over time. And REIT securities, of course, they're very liquid. You can get in and out in a heartbeat. They're tax efficient, as Rob was saying. And another thing to think about, you don't buy a share in a REIT, you buy a unit. It's a flow-through unit in effect, and you get all the depreciation and return of capital, the ROC, as Rob was saying. And when you sell, you're not recapturing any of that for your taxable income. You only getting charged for a capital gain on the difference between your purchase price and the disposition price of that unit. So highly tax efficient as well as liquid. Bit of a busy chart here, but self-serving. Rob was pointing it out. The top red line is Artis' AFFO earnings, and in effect our AFFO yield is over 8%. The middle black line is the average yield for REITs in Canada on the TSX, which is about 4.5%, and that's also where Artis' cash yield is about 4.5%. The bottom blue line shows you where bonds are yielding, the 10-year bonds under 2%. You can see the spread is almost 3% between bond yields and REIT yields, and then almost 7% between bond yields and Artis' earning yields. And one more self-serving chart. About here you see it's a busy chart, but the black line at the top shows you the performance of the TSX REIT index as compared to the TSX stock index and the bond yield. So the REIT index has outperformed the rest of the indexes for quite a while now. Now some market considerations as I get to the end, and I guess it's going point by point. So there is a wall of capital chasing real estate, both debt and equity, and this continues. It has for some time now. It continues to grow in 2019. Since 2005, pension funds, insurance companies have increased their allocation to real estate from 5% to 10% to 15%, and I see it continuing to increase as interest rates remain low. This is all about interest rates remaining low for a longer period than previous consensus predictions, and this in turn, of course, puts upward pressure on real estate valuations. So a couple of fun facts, and Cam alluded to this before. Since 2008, global money supply has in fact tripled. It's tripled. Now just imagine if all of us, and this goes back just 10 or 11 years, if all of us in this room had 3 times as much money today as we did 10 years ago. We'd all be wearing party hats, or we'd be having this event in Monte Carlo, right? 3 times as much money is out in the market today as 10 years ago. And also, as of 2019, I've got, my number is 15, but Cam was saying it's $17 trillion of US dollars of global debt is now negative yielding. 17 trillion, that number is climbing. So this ultra-low interest rate environment is, of course, pushing more money into all types of commercial real estate. And that brings me to my last slide. I'll just say, Artis REIT 101, I'm back to the beginning again. So Artis is a $5.5 billion REIT with a conservative balance sheet, investment grade credit rating, folks, a conservative payout ratio, 55% payout ratio. It's the lowest of all of the commercial REITs in Canada by far. The average payout ratio for commercial REITs is about 85%, and for multifamily REITs, it's about 75%. So we're at 55%. We're in very good shape. We've got great real estate, a well-diversified portfolio with an improving growth profile. And of course, we feel that today, at the price we're trading at, the cash yield and AFFO yield, we represent an attractive valuation and a good entry point. And that is the end of my presentation. I thank you very much. Thanks,
A lot of acronyms in there for sure. The payout ratio, just to be clear, that's the percentage of the, you guys measured with AFFO, or do you measure it from AFFO? So it's the percentage of funds from operation that are actually paid out as a dividend. So Armin was saying they pay out 55% of their funds from operation as a distribution to the unit holder. Adjusted AFFO, yeah. Thank you, Armin. We'll get more into that in a sec. I also want to give some time here to another gentleman that flew in here from Toronto. This gentleman's focus is on private real estate. So there's a definite, I believe there was a mention of a bologna sandwich in the fridge earlier. We know there's no free lunch. So the neat thing about this, and I'm really excited to have both of them, all 3 of them, but specifically on the real estate ownership side. So when I say ownership, I mean equity side. So these 2 gentlemen here are both talking about ownership in real estate. And the cool thing is 2 completely separate vehicles, and they're done differently with a very clear purpose for each. And who knows, some of those might be for you and some might be for others. But I'm excited to have him here talk about it. In a nutshell, generally these private REITs, the return profile is generally going to be higher than a publicly traded REIT. There's typically aiming for significantly higher returns than in the publicly traded REIT. They're hoping to find some low-hanging fruits. They're hoping to be able to convert an asset. Maybe they're able to rezone a piece of property, add some stories to it. Maybe they're able to convert an older building into something, reposition larger suites into smaller suites, something that's going to immediately or hopefully in the next 2 or 3 years improve the cash flow of the property and be able to exit that property at a significant profit. Now, typically, the less appealing things, there is no free lunch, right? The less appealing things might be, in some cases, liquidity. So liquidity means how easily are you able to convert your capital, your assets to cash. So typically, there might be in some of the projects that Cameron's going to talk about some hold provisions, a year or 2 or 3 or sometimes longer. But there's definitely a higher aim for target return on these projects. Private equity, super important. I think you've probably heard about it. It's kind of the sexy word on in the pension space right now. This used to not be accessible to Canadians. Well, none of private debt didn't used to be accessible to Canadians. Neither were REITs for that matter, but certainly not private equity. Really excited to have Cameron here. Cameron Hurst, CEO of Equion Capital.
Thank you very much. Pleasure to be here. I too was a little shocked at the snow, although I would take October over February any day of the week. Investors Group, I don't know if this is like a local known thing, Investors Group, hometown company, they used to have an analyst day. And for investors, analysts, equity sell people or sell side people would come in, but they would always host it in February. and they took attendance. And if you didn't show up, if you were a research analyst covering the company and you couldn't be bothered to hit Winnipeg in February, then you got taken down a notch on the list. Always show up. Attendance matters. So it's a pleasure to be here. Private equity, we're going to talk about a couple of things. Disclaimers, you can read them on your own time. Nobody will. Private equity is one of these things. We hear it a lot. There's this kind of growing din of alternative investments, structured product, private equity, CMBS, RMB. As Bay Streeters, we like to make it as confusing and complex as possible. So private equity, I'm gonna take all the fog away. Hopefully, I'm gonna shoot a little bit from the hip to get us on schedule. And hopefully this will just really simplify something, because people love talking about the alternative space right now. I'll give Rob a totally worthwhile plug, because he is one of the unfortunately fewer advisors who really gets this. And I am sad to say, of the 1,000 advisors we talk to across coast to coast in Canada, less than 10% of them, for sure, I even want to say less than 5%, actually understand the benefits to client portfolios of engaging some of your capital in private equity, private debt, the alternative sleeve it's called. And it's a real advantage to have someone who gets this and builds you a proper portfolio for today. So you hear all of this stuff. Well, really, what is it? Okay, what does Equium Capital do? So private equity is really, it's just an equity investment. So we build funds. You know, you think mutual fund. We just build a fund, an investment fund that invests in equity. The difference is it's private, so it doesn't trade on an exchange. That's it. You have to go straight into the deal to buy it. You don't go and buy shares of something like a REIT that trades publicly. So that's it. You're buying a piece of real estate. You're putting money in a fund that is an equity fund that invests in real estate. That's it. That's all it is. So we have a very focused mandate at Equion Capital, and Rob alluded to it. We take what was traditionally sort of an institutional product and elevate it to those who had hundreds of millions and billions of dollars. And we make it accessible to families and individuals who want to put a much, much smaller slice than $100 million into a piece of real estate without having to buy shares in a company that then goes and buys real estate. So you can own a piece of real estate, a fraction of it, through a fund, and it is equity, so you actually own it, and that's what we do. We facilitate that investment. It's really that simple. Now, a couple of things. We don't build stuff. We facilitate the builder. So typically, and we'll talk about our numbers, but typically, you know, somebody will come with a deal and they'll have the land, maybe they'll have the zoning done, they'll have their plan. And something always goes wrong with the plan, but they'll have their plan. Maybe if we're lucky, they even have the debt financing lined up, and what they're looking for is the equity investors. The developer will typically have 20, maybe 25%, maybe 30% of the whole equity requirement to buy this property and go forward, and they'll put it in, and then we put in the rest. You put in the rest. We do it for you. So you own a controlling stake in this company. That's something we feel very strongly about, control. And we only partner with mid-market developers. I'll spend a little time on that. So they're not huge, huge deals, but they're not one-off homes or a series of sort of 4 townhouses. It's not the mom and pa home building, one project, but the project is really just a home. We want a building. We want $40 to $60 million cost budget. We need something that's mid-market, but as soon as you go above this, you start competing with a whole other raft of people, and we don't want to do that. We like the big margins and the returns for investors in the middle. So we find good developers across Canada who know how to do this, who build the right teams, who know how to put the buildings together. We only go with the best ones. We only go with the best projects. We're very fussy. And we partner with them, fund a project, and away it goes. Now, the funds are illiquid, and that is probably the most important thing you can absorb tonight. This is a small piece of your portfolio, and it is capital that is tied up. Sometimes, I mean, Rob maybe undershot a little. Sometimes it's a year or two. More likely for us, it's between 3 and 5 years. Now, if you think of 10% of your portfolio being tied up for 3 to 5 years, that's probably fine. But it can only be maybe 10% of your portfolio or 5% of your portfolio in one project. You have to be very careful about the illiquidity. Now, why would you do this? For the next bullet. It's got a great return. So if we do our job right and we manage the risk right, what we hope to deliver is something like a 50 to 100% return over the life of the project. Well, think about that. So if you put your money in, and I'll talk about a project in Ottawa that's live right now, and some people in the audience have some capital invested in that project. You know, in 3 to 3.5 years, we give you back your original capital, and then we give you back your original capital again. So net of all fees, you've doubled your money in 3.5 years. It's a fantastic return. It doesn't always work out that well, and there are risk mitigations that we put in place to manage these things, but that's our goal, and more often than not, that's the goal that we hit. One more. All right, so what do we actually do? I think of us as, and this might sound a little funny, I think of us as a service company. We have a product. Our product is investment funds. But I think intellectually of the team as providing a service. And what is that service? Well, the single biggest one is sourcing deals. We have a flow of business that comes to us. We look at, believe it or not, we look at 1 to 2 deals a week. So we've got all the network and the connections and the relationships. It comes from lenders, it comes from the banks, it comes from the private lenders, the B-Lend, Home Capital, Equity Bank, Equitable, Cameron Stevens. All of these, they all kind of filter deals through brokers. It comes from all over the place. But think about that, 1 to 2. So we look at over 100 deals a year, and our goal is to bring you 1. So let's say 100 deals we look at, we probably get into deep due diligence on about 10, 1 out of 10, is actually worth us spending the hours and the money to really get in and rip it apart. About 1 out of those 10 are good enough, strong enough, and right time, right asset class, right developer, right zoning period, right everything to bring to you and say, like, and Rob knows this, we'll put up our hand and say, we got 1. This is a good one. And to give you a sense of it, that's over 100 deals that have gone through to produce that 1 opportunity. That's one of the biggest things we do, day in, day out, week in, week out. And we do it a little bit differently. One of the things to appreciate about real estate and people who build real estate is they love leverage. It was really interesting to hear those numbers about Canada right now, how we've moved wildly from one end of the spectrum on debt and leverage to the other on a global basis. Real estate people have always been on that side. They live and breathe on that side, and that's how they create this incredible wealth with real estate. Talk to the wealthiest people you know, and I guarantee most or all of them will say it came from real estate because they lever it up massively, and then they ride the cycle with interest rates coming down and create enormous wealth. The trick every time is very few of them are good at changing and going the other way differently. So they ride it up, and then they ride it down. And fortunes have been made and lost. I heard a great note about the American Rockefeller family. In 100 years, they have gone shirt sleeve to shirt sleeve 3 times. So there's an old adage, it takes a generation to build it, a generation to grow it, and a generation to blow it. And that is very true of real estate. It goes up and it goes down. We bring a capital markets discipline to the process. That is, it's time to exit. Very simple, but that's really what we're good at. So after we find the right project, we do the due diligence, we understand the business cycle, we do that whole thing, we bring our capital markets discipline, then it gets pretty easy. Then we oversee the project. As has been pointed out, something always goes wrong. You get punched in the mouth and the plan kind of goes off. But if you've done your due diligence right, you've got the right team in place, you're working with the right developer, it's okay. There's always a way to work through it. I'll give you an example. The project in Ottawa right now is a few months behind. Cities are taking longer and longer to grant permits. The demolition and foundation permit took longer, took about 3.5 months longer than expected. In that 3.5 months, we kept pushing, got it done eventually. But we also looked at the financing side of it. We had more time, and where can we clip and pull and fix? And we moved from addendum financing to king set. And we knocked off 3/4 of a point on the financing. That 3/4 of a point makes a huge difference to the bottom line. So there's always some way, and when your oversight is on top of it, and you're really looking at the details, you can always fix things in a reasonable course of time without affecting your bottom line. Lastly, the fun part is investment monetization, and this comes at the end. We do not do income. It is not at all what we do. We are into buying something, building something, and selling something and giving you your capital back. Our hope, if we've done a good job, is that we give you your capital back, ideally 1.5 to 2 times your money, and you say, wow, do it again. Here, where's the next deal? And then we just keep having this virtuous cycle. That's how we hope to win the favor, do a good job. Rob supports us that way. You will as well, hopefully. But we have to produce. We're all about performance. So the monetization sometimes can happen in 2 phases. Generally, though, it's all at the end. So you just have to be aware of that illiquidity. Now, the team itself is small. We're less than 10 people in all. There are 3 principals. I will evidence our discipline by saying Anna is Swedish and is not totally, but remarkably devoid of emotion. She can make the coldest decision calmly and ruthlessly, and it's an amazing thing to see. To her right, Adam Merle, who's also a director, is Austrian. So he too shows very little emotion and can be incredibly harsh in the meetings when you need somebody to really lean. So we have the right team in place to impact that discipline that is required. We have the analysts behind us, but really we do the first cut. And then we elevate our work to really, really high-level specialists at PwC Real Estate, PwC Audit, at BLG or at Castles, and Castles does most of our real estate law work, and they square everything. We just firmly believe that it's always better to have someone who is even better than you looking over your shoulder. Much as we look at all these different deals, sometimes we miss something and we want to make sure it's clean and tight. So just a couple quick notes now. We really like being small. So there are only 3 principals in our firm. There's less than 10 people in the whole firm. I mean, we use a raft of people, but we like it small. Why is that? Part of it we mentioned because if you go upscale and you're doing $150, $200 million project, well, you're competing with the REITs and the pensions, and it's just a totally different swimming pool. The margins and the returns get compressed, much tougher. Also, projects are longer. We'd rather get your money back to you sooner, get you a good return, and then start the cycle again. It's better for everybody. As opposed to tying your money out for, say, 7 or 8 years, we like 3, 4, maybe 5. The other major aspect of this is they tend to come to you with the deal, with the piece of land, with some of the equity capital in there. And so it's a digestible size. The project in Ottawa, in total, we put in just over $5 million, about $5.5 million in that. That's a reasonable raise for us to do. We don't have to spend a year raising that capital. We don't like doing capital calls, so you put your money in and then your money goes in. We're not going to call you and say, 6 months later, send us the other half of the money. It just complicates things. Most people come, some people don't, then you have to chase them. We like clean, we can't stand risk, so we'll take it out every single step we can. And playing in that mid-market gives us all kinds of opportunity to take the risks out. One of the biggest ones is this. Greenfield, you heard it mentioned earlier, greenfield is when you basically have raw land and you start from scratch. That tends to be, as you can see, it's a very approximate timeline based on the project and the asset class, but that tends to be 7 or 8 years, 9 years, sometimes 6 if you're really good and it's a smaller project, but it's a longer period of time. For that, you tend to get a higher level of return. You would expect that. More illiquidity, higher return, makes sense. But the problem is a lot of this extension risk, in other words, it takes longer and longer to get the approvals, you're not really getting compensated for it. So what we like to do, and it's much more viable in the mid-market space, is come in when they either have site plan approval and the zoning's done, or they've got zoning done and they've got first comments back on site plan approval, but they're right there. We're willing to take a little bit of a haircut on the return to shrink up that period of time and have a much greater level of certainty for investing your capital into an equity project. Once you get into construction, you've got a really good level of certainty. Things can go wrong. You can have a few months here, a month there, a few weeks there, here, there. But you've got a defined window of time that is a reasonable expectation to forecast, and then come to you, to your advisor, and say, this is what we think is going to happen, or better. For example, the fund in Ottawa, we said this is a 4-year term fund. We think we can do it in 3. We're probably looking at about 3 1/4 right now. But we'll tell you it's a 4-year fund, and then we'll try to do better. It's very hard to do this with big projects. But with something smaller, you have, that's not, again, a couple of houses, but it's, in Ottawa's case, a $38 million budget, 140-unit building. It's going to be very attractive to REITs and family offices after, and that's who we'll sell it to. you can really hone in those risks, and it's a big deal, especially for private equity investing. So this is the project that I've been referencing. We partnered with Smart Living. Just to give you a really quick example, Smart Living is a multifamily developer. They do some student and some multifamily rentals in Ottawa. We would like to take them to Guelph and to Windsor and to a couple other places. B markets, definitely not the GTA because of land costs, but they have what is called a micro unit. You're going to hear a lot about it if you haven't read about them already. They're definitely not where I live with my wife and 3 kids because they're about 320 square feet. So if you are 22-ish to 28-ish, or you're a consultant working for the government, maybe you're an affluent student and a little bit younger than that, there's a very tight band, we call it millennial living, where you want a small footprint place, fully furnished, with amazing amenities in the building, great rooftop patio, movie room, games room, fantastic bike room, all these things where basically it is, I like very cynically to call it lazy living. You show up with a hockey bag of clothing, you drop your bag, you're in. They will move in 140 new dwellers into this building in 3 days. That's how fast they can do it because of the structure. So your stabilization period, which is the period when you lease up the building, is incredibly fast. In a traditional building, you book the elevators, you're moving furniture, the building gets banged up. It's a totally different thing. Smart Living has figured out a phenomenal concept that is coming. It is being written about all the time now, but they've been doing it forever. How did they figure it out? Because they housed the people who are in it now as students. So they've been doing this over 10 years. They've got more than 20 buildings now. They've got a finely tuned machine from the leasing, all the way from the development to the construction to the leasing and operating. They get their space. They're not trying to be something they're not. They're amazing at this. So this is who we partner with. The last thing I'll say about this that we really like, and one of the reasons Equion Capital has moved more away from the public markets business and is focusing almost exclusively now on private equity and real estate, there are embedded value creation mechanisms in this. So long as you buy the land right, you can blow your brains out buying land too expensive every day of the week and twice on Sunday. But if you're disciplined on buying the land and you buy right, and you have the right model, I mean, trade costs are it's very commoditized. They're all about the same. You've got a certain band, that you try to be at the lower end of. Buy the land right, work with a good developer. Once you've done that, you've taken away almost all of your risk because you can't really blow up as you are adding value to this piece of land, to this building, because you have something tangible. You have a hard asset that you can turn around and sell. So yes, it's not totally recession-proof, but multifamily, we believe we're end of the cycle. Multifamily does very well in tougher economic times. People either move from a house to a condo, from a condo to an apartment, they lose their job, they have to sell their house and move into an apartment. Multifamily does really well in slower economic times. Not surprisingly, you heard a whole bunch of reasons there, or different perspectives, but we also believe we are end innings of the game. Lastly, it's great to build stuff. I know that sounds really funny, but you actually own a piece of a building. You will see in your annual report particularly, there will be signs of the building that you own in Ottawa that is being built and going and people are going to live in. It's actually an amazing thing. It's not just this esoteric mutual fund where I've got a little bit of this company, a little bit of this company. No, I own a piece of this building. There's a lot of pride that comes out of this. The returns are fantastic. Be careful of your liquidity. Rob can guide you where and how to use it in a portfolio, combine some debt, combine some public income REIT exposure, and then have some ownership of some equity that really compounds your growth in the portfolio. And we'll be bringing out about one project a year. So look forward to the fireside chat. Thank you.
All right, really neat stuff. So what we're going to do, I'm going to move over here. I was there, but I'm going to move back there. We're going to chat a little bit with these guys. I've got some burning questions that I have that I think would make a lot of sense to ask you guys. I'm also going to ask you guys to hold your questions. We're going to have a bit of a question-answer period at the end. I'm going to get right into it as I'm breaking stuff. All right. Fireside chat. All right, Armin, you're going to get the first question. Is that thing on? Did you put it on?
If you show me how, I will. Testing.
Yeah, there we go.
No,
All right, Armin, I'm curious about the buildings that you end up deciding to buy and why you decide to buy them. And I'm kind of wondering if you could touch on basically, accretive value to the shareholder, cap rates, leverage, that kind of stuff. Because that's kind of the metrics that you will eventually be measured by from your shareholders. So how do you decide to buy a building? What are the important factors for you?
Well, sure. First of all, as a REIT, we're looking to buy existing income-producing properties, and it starts with, well, what asset classes are we in? What are our target asset classes and our target markets? We mentioned 4 major markets in Canada and 4 in the U.S. And then we look at our earnings. I mean, not just the cash yield, but our AFFO yield of over 8%. So we've got to be able to buy on a levered basis a property that's going to be accretive, at least neutral or accretive to our earnings on day one. And then we've got to believe with some thorough underwriting, that income is going to be growing over time. On occasion, we'll buy a property, if it's really good real estate, that's not accretive on day one if we believe the in-place rents are well below market and we can raise them and get ahead of ourselves that way. But it's all about increasing our earnings. We're a real estate investment trust, we're a trust, and so we're primarily investing in passive assets that grow over time. Now, about 5% of our assets, Rob, are greenfield developments. The bigger you get, the more you can do some of that. Those have proven to be wonderful investments for us. All of our industrial developments are yielding over 7%. We're highly accretive. So then you get new generation real estate at higher unlevered yields than you could by buying them. And of course, the exit cap rates, they start with about a 5. So there's a good spread there if you ever want to exit. Does that help you?
Absolutely. Cam, tell me about your typical, again, private debt over there, in case you don't remember. Private debt over there. Typically, I would imagine you'd say potentially everyone, or would you say the conservative investors? Who are your typical owners, and what percentage of asset allocation do you think a typical, either retiree or business owner should have to the private debt space?
Right. So our typical investors are retail. That's the vast majority of our investors, I would say. Out of the $800 million in market capitalization, about 80% is retail investors. It's no surprise they're looking for yield. There's a decent yield on our stock. The thing to keep in mind is that we are also structured as a flow-through vehicle, meaning that the tax characteristics of our underlying investment are borne by the end investor. In our case, the underlying tax characteristics is interest payments. So those are taxed as regular income. So for the most part, things that are registered, tax-free savings accounts, things like that, that's a good place to shield that from that tax. I'm probably not the expert to tell people what they should hold or not hold in their portfolio. I would leave it to individuals such as yourself, Rob, but I think everything in moderation.
What we typically do at the Tetrault Wealth Group is we'll take a look at the entire portfolio, the entire pie, and we'll say, okay, this client should have, we think they should have 10 or 15% private debt, and from that, we would allocate. So in your case, if it's interest income, that would definitely go to your RSP. Right? Because it makes a lot of sense. If you have a corporate account, if you have a non-registered account in RSP, we'd say, all right, the Timbercreek here makes way more sense in an RSP. It's not going to be taxable for you, right? The income is not taxable. We're way better off having, Artis or Equium in the non-registered account. Cameron, I'm going to ask you a question about, I see here in this room there are some developers and individuals that have made money in real estate. I know them, I've seen them. So aside from those guys and gals who would argue that they have a competitive advantage because they have a business or they do it on their own, why would someone else, someone like me, someone like my dad, someone like Randy over here, why would they not try to do this themselves, instead of, partnering up with someone out in Toronto or in Ottawa? Like, why would they partner with you?
Sure. So, you could immediately suggest you take out the margin, right? Like we earned a fee to do this. Yeah. We have costs, the audit, the due diligence, all of this. So if you think about it from that perspective, take the fees out, do it direct. Would be the question, why not do that, make more money with it? There's probably 2 main reasons. One is deal flow and access. So, we look at 100-some projects a year. the opportunity to find that one gem is just better. You know, we have a much higher hit rate, potential anyway. So far we haven't had a single one go wrong, but we have a much higher potential to find that gem, as opposed to someone who, again, taking the people that are not in the space professionally, you'll always hear things kind of like the market's nearing a high when your taxi driver's, talking about a stock or the cannabis stocks, the .com. It's kind of the same thing with real estate. A lot of people are talking, I've got this real estate opportunity, I'm doing this, we're doing this townhouse. You hear about it a lot, but are these people do they really know what they're doing? When they say to you, we're going to get a really cheap cost, do you know what, how many is $200 a square foot for your hard cost? Is that good? Is it not good? Depends on the asset class, depends on the city. Building something is a really straightforward business. It's fantastic that way. It's tangible, it's understandable, but there's a lot of nuance. There's an experience set there that we bring to bear on every deal we look at that we probably don't articulate every time we talk about it, but when someone throws something at us, there's a really good reason why we throw it in the garbage in 5 minutes flat. And if we do get into that 10% and we get right into it, well then we're drawing on a body of knowledge that allows us to bring to you a better risk-adjusted investment. That's what I would say. And then for the developers, I would just encourage you to learn to think in percent as opposed to dollars. Because if there's one thing I know about developers, they don't have a real strong sense of the time value of money. It's a capital markets discipline that we kind of have hammered into us in our whole career. But sometimes it's better to sell for a number that's lower than you think you can get, but now. And that's a concept that's hard when you're married to a project.
Especially if you can roll it into another deal, right? And get the net present value of that dollar working for you again. My father, Claude, who was licensed in this business in 1976, who's a key member of the Tetrault team, brought to the office the other day a little, I'll call it a presentation like this. It was dated, I want to say April 1982. I could be wrong, but I think it was 1982. And in it, he was making an aggressive pitch to his clients that he could lock in some 30-year Government of Canada's, I believe there was 12 1/4 or 12 3/4, and he was making an aggressive pitch back then to his clients and saying, listen, like this makes a lot of sense for you. I can, like, imagine how easy my job would be if I could lock you guys in for 30 years at 12 3/4%, or at least for a portion of your portfolio. Anyways, the reason I mentioned that is interest rates have moved a lot. If you didn't catch that, interest rates used to be a lot higher. They're a lot lower now. However, Canada today chose not to adjust their overnight lending rate, leaving it at 1.75, which happens to be the highest of all the industrialized nations in Canada. This question's for all three of you. I understand it's going to be different answers. I'll start at the end with you, Cam. What do you think about, first of all, the future of interest rates? I know you're going to tell me that's not my job, but I do believe you for sure forecast interest rates as part of your job. How does it impact your MIC, whether or not they go down, which I think more people are now predicting than going up? How does that going to impact your MIC, your performance, and your decisions in your investment vehicles? For all three of you, I'm going to ask you that.
Starting with me?
Please.
So we do obviously focus a lot on rates. And sometimes the fundamental, you'd like to look at it as an economist and think about the fundamentals that are driving the economy, and if there is strong employment, wage growth that's driving inflation, that's driving a need to adjust the rates. I think that kind of rising rate environment. I think that's a sustainable characteristics, particularly in the commercial real estate segment, where if you're talking about strong wage growth and you're talking about support for consumer on the retail side, you're talking about support for rents at the businesses, etc. I'm not sure I would describe it as red hot right now on that.
You think they should have cut today?
I do.
Armin specifically said he thought they should have cut.
I do. I don't see that where we are relative to others. Is I think that's the consideration. I think the consideration has more to do with the C versus U dollar trade than it does necessarily with the underlying economic fundamentals in terms of interest rates. For us, interest rates drive a few facets. I think most people are looking at a softening or a reduction in rates over the next 12 months. In this country, at some point, we'll come to that recognition. That's supportive of our borrowers, gentlemen like to my left, who are looking to invest in real estate and do so. The lower the rates, you're going to hear from those in a moment. It's positive for them. If it's positive for them, it's positive for us. Secondarily, I described our strategy where we'll lend at 5.5%, 6.5%, and we'll use leverage to generate that 7.2% return for our investors. So to the extent that our borrowing costs, our leverage is lower, that also increase the amount of cash flow that is available to our shareholders.
Does the spread remain the same for you guys on lower rates than at the high rates?
Yeah, it's our lending is a little bit inelastic, and so there's not a direct correlation with the rates that we can lend at. There are other factors at play. That it's not necessarily that if rates are falling 25 basis points that the rates that we're getting are falling 25. They're sticky, but they're sticky both ways.
Fair enough. Armin, you touched a bit on it earlier. You guys, I would imagine the answer is quite clear. It's less of an expense. Do you see any interest rate move? And I'll let you perhaps speak on that.
Well, sure, and you heard me and all of us talk about the near inverted yield curve and what the Bank of Canada is doing. Cameron's right. It's also about the exchange rate. Our dollar. We don't need a strong dollar. In our case, we own a lot of industrial properties on both sides of the border. And I remember when our dollar was at parity, our industrial properties were about 88% full. The rents were in the $3 and $4 range. And then when as our dollar slid to 75 cents, our occupancy went up to close to 100%, and the rents more than doubled on our industrial portfolio alone. We've got good equilibrium right now in the industrial sector, for example. But I find myself saying more often than not that now is a really good time to be in the real estate business and all aspects of it. Last fall, as we got to near the end of the year, you might recall November, December, rates were rising up, short-term rates were rising up. We tested the Fed rate, overnight rate tested 3%, and we got a mini bear market in December. And then the central bankers worldwide said, hold it, we're sorry, we won't do that anymore. No, we won't shrink our balance sheet anymore, the Fed said, and about $80 billion was pumped into the market during January to March last year. And now the Goldilocks economy is back, not too hot, not too cold. That's just perfect for real estate. If it's a hot economy, we get nervous that we will get inflation and rates might rise. So we like it. It's not too hot, not too cold. And now, as far as I can see, the bond market is looking stable and predictable. And for us, we're borrowing primarily based on the bond market anyways, the market. And as far as I can see, interest rates are either level or falling. There's nothing to indicate they'll rise. So it's great as we renew mortgages. We're happy to renew them at lower rates and make money the easy way. And if we're buying properties, we've got to be careful because that means if interest rates are falling, that means cap rates are falling and prices are going up.
Thank you. What would be the blended kind of cost and the duration that you guys would have now? That's public, I would imagine, right?
Yes, it is. Yeah, and we're still going a little shorter term because it's just a gift, and I'm not concerned about the rates rising. We're still taking 3- and 5-year money, but 10-year bonds in Canada about 150 points. You can borrow money at 200 points, a spread above that, and at 3.5% you can get 10-year money. And if it's multifamily, you can get it a lot cheaper.
Thank you. Cameron.
I can't really add a heck of a lot to that, to be honest. I mean, I think, the government of Canada, they had to get reelected. The Bank of Canada, I don't know what they're looking at. Maybe they're following Trudeau's lead. And they're not, in our opinion, dealing in reality, where Canada is continuing to slow. The best thing they did today, which I think is at least pointing in the right direction, was reduce their growth outlook. So what's happening out west. Alberta is up in arms. There's a big pipeline mess. It's just not good in the country. So the rates are coming down. At a minimum, they're staying the same. Economic activity is slowing down. The U.S. is this crazy hot air balloon that just refuses to fall. You look at what's going on in Europe. The developed world is in a manufacturing recession. Everybody's cutting rates. And then here in Canada, somehow we think that we don't have a debt problem. So we think that the Bank of Canada is in a real corner. Rates are stable to falling. and that's great for us. Without getting technical about it, that means stable growth, even if it's a low growth and a stable and falling interest rate environment, is great for real estate. We're in multifamily focused right now. We'll wait till some kind of a crash happens, and then we'll look at office and industrial again. But for now, lower rates are nothing but good for us.
Right, and I think there's consensus here on the floor that they should have cut, and that likely the next thing coming is likely a cut. Not that these are economists, but food for thought. The next question, Cam, let me ask you about the portfolio currently today. What does it look like right now, and what are you seeing, and is it going to be shifting in the future? Specifically, where's the debt? What kind of yield are you getting on the debt, and what does it look like?
Yeah, we're about 55% exposure to multifamily right now. That would be obviously it's more than 50%, so that would be our largest asset class. We're heavily exposed in terms of provinces to Ontario, Quebec, BC, and Alberta. We do have some exposure here. We're mostly urban, 90-odd%. So we really focus on large centers. You've heard a lot about liquidity today. Liquidity, you don't think about it a lot till you need it. If you're in the larger centers, you may not like the price, but at least there's a price when you need it. In terms of other characteristics, our average term to maturity, you saw it on one of my last few slides there, is about 1.1 year. We didn't talk about it. I can't believe I've talked as much as I have, and I haven't mentioned LTVs yet, loan to values. We're in the high 60s, depends on the day, 67, 68%.
Just to be clear, loan to value, the percentage of the assets that are being lent on, so loan to value, the loan percentage to the value.
Said differently, these gentlemen have the inverse of that number. So if it's how much equity you have in the project, 20 or 30% equity in the project, it means the inverse of that, 70 or 80% of it is debt. 70 or 80% is the loan to the value of the project. So we're sitting sub 70, high 60s. We're comfortable at those levels at this point.
Good, thank you. Armin, I'm going to ask you about, you've got obviously a ton of experience in creating wealth in real estate. For people out here that are looking at creating some wealth in real estate, what are the best indicators, long-term wealth creation in real estate? So what are you looking for the specific indicators in real estate that you think are the best indicators of long-term wealth? I'm not talking short-term cash flow, long-term wealth.
Well, I don't know how theoretical we should be getting. I'm just a hobby economist, not a real economist.
Yeah, well, you've done the odd real estate transaction in your life.
Well, of course, yeah. I mean,
$5 billion worth or something?
Yeah, over 5. Yeah. I mean, for example, if it's acquiring a piece of property, we look at first of all, what are we paying versus what we think the replacement cost is? And what about the market and the micro market it's in, the demographics, the trend lines? What about supply and demand for that specific asset class? We're doing very well with our industrial and retail right now, but once in a while you get into an office market where everything's fine in the economy and in that city, but then you've got an oversupply, and then your rents go down and vacancies go up. So a lot of things. The due diligence checklist has gone from the back of a napkin to multi-pages over time. It's a very transparent market now, sophisticated market. So you can do a lot, but you're looking at a positive revenue stream. You're looking at you don't necessarily need to climb the risk ladder too much, but you want stable income that's growing over time. And you want to believe that based on the fundamentals of that market. Now, in terms of asset classes, it varies. Multifamily has always been a favorite asset class in many ways. It's always been viewed as the safest asset class. You can always rent a suite, and it still is. In Canada, it would be considered the most desired asset class. And then you get industrial, then you get office, then you get retail. In the United States, actually, industrial is the most desired asset class. Today, multifamily second, and then you've got office and retail. Retail's getting a bad rap right now everywhere, even though in general it still continues to perform well. Does that help you a bit?
Yeah, and I'm going to ask you a follow-up question. You talked about vacancy rates, specifically Winnipeg. I was on the phone with one of my friends who's in the commercial real estate space in Winnipeg. He told me that the vacancy, I have no idea if this is true or not, the vacancy rate in Winnipeg, he told me it's above 10%. In the commercial space. for the first time in a while. You're in Winnipeg. The True North buildings come up. I hear there's a Wawa building coming up in 2 or 3 years, or 3 or 4 years. 300,000 square feet, I think. These holes that are happening in the buildings in Winnipeg. How do you feel about that? And is that a concern for Winnipeg, the vacancy? Or is it more of a growing pain that we have to go through because these buildings are coming up in large chunks?
So it's a combination, because we haven't had a new building for several decades, right? Then True North Square was built. And you know, as a landlord of existing buildings at Port Germain and elsewhere, I say to myself, gee, I don't want to see any new buildings get built. However, it's good for Winnipeg. It's good for the market. And I think, and there will be trailing vacancy caused, but it'll be trailing vacancies in the B and the C buildings. And yes, Wawanesa is coming up next. We should all be grateful for Wawanesa. They keep growing in Winnipeg, creating more jobs. When they build a new building and move in, there'll be some trailing vacancies. And so, yeah, it'll be a bit of an overbuilt market, but it'll be manageable. We'll all work hard and roll up our sleeves and work through it. It won't be a problem per se. But by comparison, I think we all have heard of the Calgary and Edmonton office markets. You know, I'm glad that in Alberta, retail is doing well, industrial is doing well, multifamily. But Edmonton and Calgary, they have about 10 years of supply of office out there. And so we're not going to be in that situation. But we are getting a little overbuilt. However, it's a brand new product. It's great for Winnipeg. And we're glad for 225 Carleton, that multifamily that was built there. And you can see 300 Main that we're building. There is that expression, build it and they will come, but it works both ways. If you don't build it, they won't come either. So these buildings need to get built to urbanize our downtown and our city in a much better way.
Yes, Cameron.
If I can just tack onto that, it also opens up another opportunity, the value add. You know, you take the C building that then has a vacancy problem, and if it's in the right location and it has to line up the right way, that's the due diligence. But it opens up another opportunity for someone like us to partner with the developer, come in, clean out the building, redo it, refit it, and then pipe it out there again. And that's called a value add project. It's being very general, but that's a value add project. And that is part of that life cycle that you end up going through. What you don't want to do is step into the serious oversupplies. You just want the incrementally oversupplied.
I feel like Winnipeg's been, because I've been around for 100 years, but I feel like Winnipeg's been, you know, a very stable market this last century in terms of real estate. Says the guy who wasn't around for most of the century. But I do feel we have a good real estate market here. And obviously I'm biased because I live here. But I do feel it's insulated from the swings, the deep swings that we see in Toronto and Vancouver. But we're also insulated from the 25-30% growth numbers that they see out there as well. Cameron, I'm going to ask you about exiting, monetization. I'm super curious. You spoke about it. Are there situations where you would adjust your monetization strategy? Take me through your monetization process, how you think it through, and why you decide to pull the trigger when you do pull the trigger on that project.
Sure. One of the things I mentioned that's of paramount importance to us is control in a project. It's also very hard to have control as a smaller player in a larger project. It's one of the other reasons we like mid-market. But the control, what that means is when you control the board and it's, say, a majority vote on the board, it's all in the documents, how it's structured. But it's generally we go with majority. So say there's 5 people on the board, we'll have 3 seats. That means we control anything on a major decisions list. Generally, that will include major financing decisions, sale process, a whole bunch of things in there. The reason we like to control that is because somebody already came and started sniffing around the Ottawa project. We're not even above grade yet. And there was a family office that came and it was a lowball offer. It didn't make any sense. But nonetheless, if they had come with something that we were 25% into our timeline and it was only a 10% reduction in the final value, sold. Why would we not do that every day of the week? So we like to have that control, and it really does come down to a financial decision for us. As much as I love building things, and then there's a bit of a sort of pride of contribution there, at the end of the day, our job is the financial discipline. And so if we can create wealth for our investors and exit on a shortened timeline, we'll jump really fast on that. It doesn't happen very often, but the to the point, the multifamily market is so hot right now, purpose-built rental is the rage, that I can't obviously guarantee anything, but I would be personally surprised if we weren't getting offers once the shell of the building was up. And so in Ottawa, that might mean, we'll be paying or receiving something like a 4.2 or a 4.25 cap rate instead of a 4, maybe a 3.9. by exiting early. We'll do the math. Maybe it'll make sense. Maybe it won't. The construction team will continue to do it, and they'll finish it and then sell it. But locking in that gain, or locking in that profit number up front earlier is always a huge advantage, and that's why we like to control the board, and that's how we think about the monetization. On the flip side of that, if there are problems that extend, the reason we pad it and say we've got up to 4 years on this is that sometimes maybe it is a trough. Maybe the economic cycle isn't really going your way and the buyers are a little bit slower. And we got some of our forecasting wrong. Adam's phenomenal, but not perfect. So we like to just have that flexibility in there because we want to optimize the exit. That could mean we get it stabilized in a multifamily situation and we roll out of construction financing, which tends to be more expensive, and into a long-term mortgage. And if we do that, then there's probably going to be a bit of a cash out. Could be 30, 40, 50% of your capital gets returned to you, and the rest of it comes back in a year once we actually sell. We don't like to do that, but we like to have that flexibility to manage the return for you as best we can.
At the end of the day, we still own that building,
100%.
right? Cam, I'm going to ask you about risks that people should know about investing in a private mix specifically, and kind of a mini follow-up to that. Why would they choose to invest through something like Timbercreek versus the private pools that are out there, the hedge funds that are out there, kind of all the other opportunities, the ads you see on BNN? Like, why would they choose Timbercreek, and what are the risks they need to know?
So most, I didn't mention it in my opening remarks, but there are approximately 200 MICs, mortgage investment corporations, private lenders focused on Canadian mortgages out there. The vast preponderance, 190 plus of the 200 are focused on single family, residential lending. There's a small segment, ourselves included, that focus on the commercial space. Let me try to answer your question a little bit on the larger piece of that pie, the 190 plus out there. Some of the considerations, the risks that you need to think about is many of them are providing second mortgages. There's another thing I forgot to talk about in our presentation. It was on the slide in terms of what our first versus second mortgages exposure is, and we're well over 90% first mortgages that we invest in. It goes to control, different kinds of control, and then having board seats. It's having the first say in a court of law during a proceeding to take back real estate if you need to. But a lot of those MICs are invested in second mortgages, and what's happening as Armin illustrated in his slides around the increase in consumer debt is you've got individuals with good steady jobs. They could be government employees, nurses, etc., that are getting extended on their credit card debt. They get up $20,000 or $30,000 in their credit card debt. Then they look at refinancing their home, but they've got a 5-year term with Royal Bank, so they don't want to pay the penalties to renew that mortgage. So, and they're only 1 or 2 years into that mortgage. So they go to one of these private lenders and they get a second mortgage. And you're consolidating credit card debt at 22, 24%. So this guy's charging me 12. That's not so bad, right? I cut my rate in half. That works if you change your spending habits. And 1 year later, because these are all structures of 1-year mortgages, 1 year later, it turns out that they didn't change their spending habits. And they got another $15,000 or $20,000 of credit card debt. And they go back to that same private lender to renew the mortgage. That second mortgage is now $40,000 instead of $20,000. And that just keeps going until values no longer support it, until there's that rainy day. And so when we look at a lot of the participants in the market that are doing debt consolidation plays, that are in and of themselves, there's nothing wrong with that. There's nothing wrong with lowering the amount of interest you're paying, but you got to make sure that the underlying spending habits change, and they apparently don't from the data that we're seeing. So,
are you worried?
It's a problem, and I think this is this stuff when you hear the Minister of Finance or others talk about shadow banks and consumer debt, and this is what they're talking about, and that's when you start to get too far out of over your skis. And so I would caution people to consider that when they're look under the hood. Who are the borrowers? What do they look like? How much are they borrowing? How relevant is that to their personal net worth? I'll stop there.
That's a great answer. Armin, I'm going to ask you about, I asked my dad today, what should I ask Armin? And he said, make sure to ask him about the proper payout ratio, or what do you think a payout ratio should be of a publicly traded REIT? We'd love to hear your opinion on that.
Well, such a good question from your dad.
He's probably asked it to you before.
Well, you see, when we first started, your dad was basically our financial advisor for the REIT in 2004 and in the first couple of years. And we started out, and basically our payout ratio was, it was based on positive cash flow, including the debt service, all debt principal, not just interest. So we had a very conservative payout ratio. Then we met the bankers in Toronto and said, no, that's not what REITs do. REITs don't do that. They don't deduct your principal. And it's not even based necessarily on cash flow. You pay out about 90% of your funds from operation, which is your adjusted funds from operation. Long story short, anyways, I mentioned when I was up there, the average payout ratio for the commercial REITs in Canada is about 85% of their AFFO, and then the
you guys are at 55.
Yeah, multifamilies are about 75. We're at 55. So we reset our distribution last year. We made some strategic initiatives. So we're at 55%. It's a bulletproof distribution, but some people would argue it's a little bit too low. But I would suggest 65 to 70% is the right payout ratio. You've got to be cash flow positive, and not look to refinance your properties in order to make the distributions over time.
And real quick before coming to Cameron, retail, the fear is Amazon, obviously. The fear is Amazon crushing all the retail and kind of getting rid of all the bricks and mortar stores.
All of that. Look, in the last 100 years, the retail sector has undergone massive transformation. We're always changing. We've always been changing our tenants and changing the format of our stores, even before Amazon came along. So now retail is a bad word. So in the United States, there's 24 square feet of retail per capita. In Canada, there's 17. In Australia, there's 11. In Europe, there's about 5. I would suggest that in Canada, we need to come down closer to Australia to about 11. We probably still have a bit too much retail in Canada. In the United States, for sure they do. So a lot of that has to be transformed and repurposed into multifamily and densified and things like that. And we'll see that happening in Canada. But yeah, retail in the investment communities gets a bad rap. The pure retail REITs in the United States are trading at massive discounts to their NAV because nobody really understands what their NAV is.
They're worried that people are no longer going to go to stores and buy stuff with how easy it is to click on a button and get your toilet paper delivered to your house.
Can I get a haircut delivered as well?
Well, no, I guess not, eh?
Right, and so there's going to be some necessity-based retail that's still got to be out there. Maybe there's a bot that they'll fly to your house at some time.
I don't know. I don't really know much about haircuts. I'm going to ask you, Cam, and I'm going to come to you guys in a sec. So I'm going to ask Cameron a question on the consumer debt. I want to, if you don't mind following up on the comment that Cam made earlier, is that a concern of yours? Are you worried about the consumer debt? Do you feel like default rates might increase? What about these micro condos that you have? Is that a concern, or you're lower on the rent scale, so you probably like being there in a situation of defaults, I would imagine?
So maybe 1 minute on background, which informs your perspective of my opinion. I worked in New York from 2003, 4, 5, 6. So think about that as it pertains to the global financial crisis. I was an analyst, a sell-side analyst, working at a boutique firm, doing research on bank stocks. So I'm sure some of you have read The Big Short or seen the movie The Big Short. There's a couple of groups focused in that, but the Front Point guys, in the movie, the name was Mark Baum. His real name is Steve Eisman. Another guy was Porter Collins. Those are real people, and those are the people that I was working with when I was in New York doing research on the financial crisis. So to say I have like really deeply rooted fears about debt crises is an understatement, because we saw this coming. We did all the vintage analysis on the credit work. You know, it was a slow-moving freight train for years. And so when I came back to Canada and started working at RBC in 2007, regrettably, I took over the financial services, all U.S. financial services equity investments for RBC mutual funds for 2007 to 2012. So I had the joy of investing in these horrendous investments on behalf of mutual fund investors at RBC. And it was a life lesson. So, you know, it became all about what not to own. And there are always mile markers along the way, always. We just choose to ignore them. I mean, you saw going from the left side of that chart to the right side of it. I mean, the bar was in red. Like, I don't know what more of a signpost you need. You know, we have a debt problem in Canada. And I thought Cam's comment about it's not about the numbers, it's about the spending habits is bang on. We look down our nose, not us in this room, but, you know, Canadians look down our nose at the US and say, like, our banks were in great shape. They weren't, actually, and nobody knows about it. It's unpublished, but CIBC was right on the ropes, and the public doesn't know it. And so we hold ourselves above this, and I think that hubris, that arrogance is going to come home to roost, unfortunately. And that kind of feeds back to the interest rate discussion, you know, and how the Bank of Canada is really painting themselves into a corner. They've done the mortgage rules, and they have done certain things which incrementally are positive. But honestly, if outside of the investment opportunities, which are amazing, you know, if you take nothing else out of this, really think about what's happening on the debt side of your household balance sheet. Because if you fix it now while rates are low and you're not against the wall, you've got all kinds of opportunities. But if you get your back up against the wall, then your opportunities slip away real, real fast, and then you can't send us your money to double your money.
Good. I'm going to open up to the crowd here. We got time for maybe one or two questions. If you do have something to ask, please feel free to stand up. I know it's tough. It's intimidating. What do you guys think of the real estate? Oh, yeah, here we go.
I have a question with respect to the Equion investments, and that is, if we invest in Equion, does that work on a project-by-project basis? So as we make an investment now, that those funds get allocated to a specific project. When it's done, you're paid out and you start all over again?
In essence, that's right. We initially, to be honest, you know, some of the history, we had thought about raising a blind trust because being risk managers first and foremost, we always think about what can go wrong, and diversification is a benefit in terms of managing risks. So we thought, well, why don't we raise, you know, $100 million fund, and then we'll go and do sort of 4, 5, 6 projects and put them in there. Apart from the complexities of calling your capital after day one, which can be a little tricky, we just found that people were more comfortable smelling, seeing the dirt. And we could sit you down as opposed to saying, trust us, we've shown you we're good stewards of capital. We can sit you down and say, here's the building, here's the city, here's the location, you know, here the demo. We can wrap the whole thing up for you, put a bow on it and say, we think this is a good one. And then 3 years later, well, we should do one of those every year. So if you come out 1 year, the goal is to always have something for you to go into, to your point. But then 3 years later, we should have one that year, and then you can re-up and do that, put in some or all of it. But the idea is to have it fund per project so that, you know, when we put our hands up, you say, okay, well, they've got one. You take some of it on faith because you know we have a good track record at doing this, but it does give you the ability to poke it and check it.
Okay, good. Oh, sorry. Yes, over here.
My question is also for the gentleman from Equium. You said you were employed for a bank in 2012. So this being 2019, how many projects has Equium actually done? And also, if you could tell me, you mentioned possibly Guelph or London. So I'm assuming you're looking at university-type cities or communities. What kind of screening criteria do you use to determine whether a project there is going to be
there's a couple questions in there. We don't necessarily look for university towns, although you're right. What you want is a demand base there. There's a couple of different demographic factors you want to focus in on. Bizarrely, Ottawa used to be a really sleepy, kind of older government town, and now it's like the destination for millennials. So demographics can change and shift, and we like a younger base that's not just related to the university, but in embedded employment, like the government is a great thing. Land costs, there's a whole bunch of factors that go into the location. I would just highlight those because they happen to be particularly low vacancies for multifamily and with younger population. So that's part of it. I went from RBC in 2012 to Barometer Capital and did some work with long-short equity hedge funds and sort of honed the teeth on tactical asset allocation for a couple of years, and then I built the platform actually at Canaccord, the proprietary asset management platform at Canaccord before starting Equium. So Equium itself is 3 years old. We've got 4 decades of family experience in real estate development, actually. So it's really a combination of that personal experience, also with running real estate at RBC and in the US, being responsible for all the real estate. So it kind of comes around. So we've done, as I said, we do smaller mid-market deals. So we haven't even done a total of 100. It's less than 100 in total raise. But we've done 6 projects. Some of them have been small club deals and a couple a little bit larger, like our Smart Living project.
Good. All right. Well, I do want to respect your time. Before we go anywhere, I'm going to give a plug to... do this or what?
Yourself.
Those of you who don't know, I'm a big believer in philanthropy. We actually raised a bit of money here today. We sold some tickets for you guys to come here, and I'm excited to be able to donate that entire sum. And I'm actually going to match that sum. I'm going to donate to the Canadian CMV Foundation. It is the #1 cause of infant disability, and it's a cause that's very dear to my heart. So I'm going to ask Derek, who happens to be a trustee of the foundation, and who happens to be my right-hand man, and employee of the month, September, I don't know, at Canaccord Genuity. And I'm going to ask Mox to come up take a picture, or someone take a picture. Is that all right? I know it's not about charity, but when we can raise $3,410 through an event like this, that means a lot to me, and we're donating all of that, and that's going to go directly to fund research for the #1 cause of infant disability. So infant disability, the #1 cause is CM virus. I'm working tirelessly to lobby to change the protocols for screening in newborn babies and a bunch of other stuff. So I'm really excited about it. We're going to take a picture, Derek. Good luck trying to catch that. So that was the plug for the charity, and part of the reason, one of my passions in life. I do want to take a moment here to thank, first of all of you for coming. I love these things. To me, it's very important. We always try to do it on something that's topical, something that's, and I have heard so much buzz in the last year or two on real estate and on alternative assets, and how does that fit in? And it truly is a wondrous, I think, a wondrous coup that these gentlemen were all able to line up their schedules to be here. I'm extremely thrilled. I'm going to give you guys a reminder of all of them. So at the end, we got Cam Goodnough. He's the CEO of Timbercreek Financial. This is private debt. This would be a 7.2% yield. It's classified as interest. It's first mortgages. In his own words, conservative lending, extremely conservative lending, very low volatility, perfect for an RSP, any conservative investor, even an aggressive investor that wants something stable in his portfolio. Cameron from Timbercreek Financial. Thank you so much for coming, Cameron. Next to him, Armin, Martens, CEO of Artis REIT. So again, Artis REIT currently pays 4+% cash flow, which is completely declared as a return of capital, which is tax-free in the year you receive it, tax-deferred, and taxed at half the rate at some point whenever you do decide to sell it. It's extremely good for non-registered accounts, for corporate accounts. Again, it doesn't touch your grind. The actual yield or the actual cash flow that's being generated inside the portfolio of mature office, mostly now 50% office buildings, is around 8 to 9% or so. So a conservative portfolio of mature real estate properties that are full and that are generating cash flow. It trades on the Toronto Stock Exchange under the symbol AX. Thank you so much, Armin Martens. And finally here, Cameron Hurst, CEO of Equium Capital. Equium is a focus on private equity. Remember, there's no free lunch. I know it's very, very attractive to hear that you could double your money in 4 or 5 years. You need to get the project right, which is what they do. You need to find the absolute best deal, and you need to be okay with your money being locked up for a while. Sometimes there's hiccups in the roads, delays, etc. This would be for a portion of your assets that you could effectively forget about, leave to the side, and kind of hope that it doubles in 4 or 5 years or 3. So it definitely makes sense for a lot of people. All 3 of these investment vehicles definitely likely make sense for some or all of you in this room. Cameron Hurst, thank you guys. So that brings the end to the formal part. We're going to stay around. If you want to chat with one of these guys, feel free to hound them. They don't fly out till tomorrow, and I know they'd be happy to answer some of your questions around. Again, we're the Tetrault Wealth Advisory Group. Brings me a ton of joy to be here. We manage clients' money for a living. We're very, very proud of the holistic wealth offering that we do. Part of it includes the investment management advice. So that includes stock selection, alternative assets, diversification, rebalancing, the day-to-day nuts and bolts of building portfolios. That's my passion. That's what I love doing. Coupling maybe a sleeve of private debt into a portfolio, seeing what it does to the risk-adjusted returns of a portfolio, adding a little bit of private equity, and getting that consistent stream of a publicly traded REIT. That's the kind of stuff I love doing, and I do believe there should be a portion of real estate at some level in all your portfolios. The other half of what we do is on the planning side. It's a holistic planning advice. So when you become a client of the Tetrault Group, this is my chance to plug you, by the way. Those of you that aren't clients, we'd love to get you guys as clients. We'd love to get the opportunity to compete for your business, regardless where you're at right now, whether you're at another bank or whether or not you're an independent. We do things differently here. It's a core focus on the client. It's a core focus on you guys. We do custom portfolios, and that actually means custom portfolios. The word cookie cutter does not exist in our vocabulary. We do not have or sell proprietary product. I've never done it. I think there's a clear conflict of interest that exists if you're at an investment firm and you're selling your own investment products, for example, at a bank that's selling their own bank mutual funds, or at any institution house that's selling their own cooking. I think there's a conflict. Strong aspect of planning. Adam Buss back here, he's getting a beer, looks like, and he's putting it away now that I'm introducing him. He's got every aspect covered for our clients on the planning side. That includes corporate structure, cash flow projections at retirement, whether or not you're ready to retire or not, what the estate is going to look like, your lending needs if you need a mortgage. Also got the insurance needs covered. So that is how we approach, and we approach it on a custom basis, client by client. If you're not happy with wherever you are right now, or even if you think you're happy but you'd like a second opinion, we'd love to compete for your assets. Once again, folks, that's it for my sales pitch. I'm going to hang around here. I'd love to meet some or all of you if I can. Thanks so much for coming. Have a great night.